I'm really thankful to Joe and Tommy for having me over, and I'm grateful to Iqbal and to Bill Harrington for making the invitation. They asked me to come over and talk about the TED spread. Let's make sure we know what the TED spread is. It's just a spread between a treasury exposure and a euro-dollar futures exposure. You can do this with cash treasuries. I'm not going to talk about cash treasuries today. This is all going to be futures to futures implementation. So what I want to do in the next few minutes is just say a few things about why this is a sensible relative value trade to be thinking about right now. Get a little bit of nomenclature nailed down. Talk about how you structure the trade. It's important because there's a lot of flexibility and creativity that's allowed in this trade. And then finally, say a few things about how you manage the position, what bids and offers look like, and so on. I have to lope through quite a bit of material, what I'd like to do is to save questions until the end. And if I don't have time for you, you'll know where to reach me. I'll make sure that you know where to contact me. That's just over at CME Group. The TED spread is a credit spread. It's treasury credit exposure versus unsecured interbank rate exposure. So, seen from 38,000 feet, this is 13 years. I mean, the spread widens out when economic conditions are not so good. It narrows when they're benign or getting better. Here, we come in right at the end of the tech wreck. So here was the 5-year TED around 100 basis points. And this is TED as a treasury to swap spread. So that's just a 5-year par swap rate versus a 5-year on-the-run treasury. You can see it sticks out like a sore thumb where the bank crisis of 2007 and 2008 blew up. And, so over at the far right-hand side is where we are now. And TEDs are very narrow relative to the last, decade and a half of history at least. About 18 basis points, give or take, for both a 2-year or a 5-year swap spread. What's more important perhaps for you all is that after a long spell of kind of fallow time, this is starting to look like a more interesting trade. The 5-year swap spread now moves about 1 to 1.5 basis points on any arbitrarily chosen day. That's over the last 6 months. That's the 50th percentile of the absolute value of the daily change. That means half the time it moves more, half the time it moves less. 2-year isn't quite as interesting, but it will catch up. If you scrutinize this moving 6-month volatility plot, you'll see that the 5-year TED tends to lead the 2-year TED in terms of volatility. So I would expect the foot of the curve to catch up with what we've already seen further out the curve. 20 years ago, a generation ago, this really was a strategic trade. People would put this on for a week or a month at a time. And you don't have to approach it that way only. Especially if you're doing this in a futures to futures context. There is plenty of room for kind of interesting and potentially profitable tactical plays. So what are you looking at here? This is a little over 28,000, 1-minute points for a particular TED spread. This happens to be the set 5-year versus the first green euro dollar. Why that spread? It's arbitrary, but I'll tell you in a moment where that comes from. But, you know, this is interesting. This is only 3 months worth of stuff. And you know, you've got clear trends both down and up. You've got plenty of potentially interesting wobble around the trend. It's easy to see what the TED spread responds to. FOMC press announcements, the remarks by the Fed chairman about tapering, the release of FOMC minutes, things that might influence the FOMC's judgments, their policy determinations, things like Employment Friday, new home sales. Here's the month of August alone. And if you want to see what a day looks like, let's look at that Employment Friday, 2nd of August. Bingo, there it is. So during the month of August, you traverse close to 8 basis points just within this day, leaving out that out trade that occurred at 7:30 in the morning when the headline hit. You traversed close to 3 basis points. So it doesn't really matter what your time frame is. There's a lot of stuff you could do. There's a lot of opportunity. So with that as the enticement for talking about this, let's just get a little bit of vocabulary down. I think most of you know this already. It may sound like I'm condescending, but I don't like to leave anybody behind. If I'm buying the TED, what am I doing? I'm buying the Treasury exposure, I'm selling the Eurodollar exposure. Vice versa if I'm selling the TED. As I said at the outset, I'm not going to talk about cash treasuries today. This is going to be Treasury futures. And you know, for practical purposes, let's just focus on 2-year or 5-year note futures. One point of advice, and I think it's probably obvious for this audience, is you don't want to build your Treasury leg on a futures contract that's in its delivery month. So when I say front, I mean the front. That's before the roll, or certainly before first notice day. The Eurodollar leg can be whatever you want. Well, that's not a very helpful statement. That's kind of vacuous, but I'll clarify. There's plenty of room for creativity on the Eurodollar leg, and you'll see the one iron law in this. The DVO ones really ought to be the same on both legs of the trade. If you get that right, a whole lot of other things fall out very conveniently, and you've got something you can manage, perhaps even profit from. So I said a moment ago that all the creativity is on the Eurodollar side of the trade. In the mid-1990s, people have done this differently, but you know, easily over the last 15 years, people trade TEDs from an agnostic point of view. They don't view it as a Treasury versus synthetic Eurobond spread. It's just a Treasury exposure versus some Eurodollar exposure. That Eurodollar exposure could be a bundle, it could be a pack, it could be a stack built on an individual contract. It really can be whatever you want. So a good place to start is to look at the correlative relationship between the front Treasury future and the Eurodollar strip. I've confined my attention here to the first 20 contracts. And that's where all the maneuvering room is, I think, for a trade like this. So what do you see? A bundle. This is for 5-year. This is just front ZF versus a bunch of Eurodollar futures. A bundle or a pack green pack to be exact, would be a conservative trade in the sense that the legs are highly correlated. The price dynamics are such that there's not going to be a lot of looseness in it. Your ability to profit might be correspondingly less. But if you have a very kind of tight risk management discipline, then you might be looking at a green pack or a bundle. Or a stack built on a member of the green year. If you want a little bit more wobble at the expense of risk control, fine. You could use one of the red Eurodollars to build a stack. You could use the red pack, and so on. The point is that this gives you sort of a visual menu of what your opportunities are. This tells you where you could put down stakes. And as I said, the room for creativity is tremendous. So once you figure out kind of where you fit on this correlation profile, then you can start digging into how the spread works. So what you got there, that's a decade worth of daily price dynamics on the left for front 5-year versus the Eurodollar strip. On the right, what you see is the same correlative relationship estimated on just May to Aug. I'll come back to why that's important in a moment. It's good to know what kind of happens generally. It's also good to know what happens lately. You can do the same thing for the 2-year. So I won't dwell on it. So let's suppose for the remainder of this discussion that you've got you want to keep this spread on a tight risk management leash. You're looking for legs for which the price dynamics are pretty tightly correlated. So for a 5-year, that might incline you to go for a 5-year bundle of Eurodollars or a green pack. If the 2 years what interests you, a 2-year, actually the red pack would be your winner there, maybe the first red in the Eurodollar strip. But you'd be aiming for things you'd be aiming for combinations in which the price dynamics correlate very highly. Here's something important: a robustness check. Yeah, what did I do earlier? I showed you a decade's worth of daily data as the basis for estimating correlation, and I also showed you the latest 3 months. It's a really good idea to eyeball short-term correlations that are sampled over short intervals, and bump them up against longer data sets for estimation, because that'll warn you about the circumstances that might cause the legs in the spread to wander away from each other. It's really easier to look at the 5-year. This is a 5-year on the left, 2-year on the right. So in the 5-year panel, that's the thick kind of baby blue line is the 5-year bundle versus the front 5-year contract. The thin black line is the first green stack. So when do things start coming apart? Well, you can see where the bank crisis of 07 and 08 caused decorrelation relative to the secular correlation value. You can see here where the Eurozone sovereign debt crisis caused decorrelation. Look at this dagger here. You can see it in both of these plots. What the hell happened there? You're going to love this. The House of Representatives and the White House agreed in early April 2011 to fend off a government shutdown. They came up with a short-term deal, and this caused Treasury prices to move one way and euro-dollar prices to move the other. Treasury prices, for obvious reasons, would be sort of the oddball. And there was this external event that had nothing to do with you, it had nothing to do with me, it was the government. If you look at, this is like walking through Mammoth Cave in Kentucky, this looks like stalactites. Every one of these sags that you see since 2011 coincides with Capitol Hill squabbles over the debt ceiling or inability to get a budget deal done, sequester, stuff like that. Keep this in mind. This doesn't mean you're going to lose, it doesn't mean you're going to profit. All it means is that the relationship between the Treasury leg and the euro-dollar leg that you think you know might come apart, at least temporarily. This is all part of good risk management discipline. So, we're halfway done. Thank you for your patience. In what follows, what we're going to do, let's just assume it's the evening of the 22nd of August. I just picked that date out of the air. We're going to set up for the 23rd of August. The DV01 for the set 5-year future is just about $49 per contract. Let's assume you want to build your TED on a 500 lot Treasury side. You could do 50, you could do 5, you could do 5,000. Let's just assume 500. The DV01 then is going to be $24,485 on the Treasury leg of your 5-year TED. So what's the size of your euro-dollar leg going to be? Whatever euro-dollar contract or combination you choose, it's going to have to add up to 979. Why? Because what's the DV01 of a euro-dollar future? $25. So that's nothing more than what you get if you divide 25 into 24,485. If I'm contemplating a TED spread with 2-year, set 13 twos. Let's assume it's 1,000 lot. Fine. Using exactly the same reasoning, I'd come to a euro-dollar structure that has to be slightly over 1,500 contracts. And just to emphasize, this can be anything I want it to be, as long as I'm comfortable, or as long as you're comfortable with where it fits on that correlation map. For the 2-year, it could be the first red. It could be a stack built on the first red. I don't see Bill Campbell here. It could be a lemon TED. Some people call it the cusp. It could be, the two contracts that are on either side of the boundary between the white pack and the red pack. It could be the red pack, in which case it's going to be, what, 389 of that. The bottom line is that it has to add up to 1,513 euro-dollar futures, or as close to it as I can get. Same reasoning would apply if I'm doing this with a 5-year. It has to add up to 979, or as close as I can make it. Now, how do I manage this thing? How do I set it up so that I can monitor it and make sense of it? I'd love to be able to say that you could look at this as a price spread. I'd love to be able to say, gee, just subtract the euro-dollar price from the Treasury price. That would give you a number that is completely meaningless. It's not something you can interpret for risk management purposes. It's not something you can interpret sensibly for position management or P&L. With a little bit more work, only a little bit more, and it's worth the effort, a sensible thing to do is to translate the Treasury futures leg into the yield equivalent. Then you have a euro-dollar rate that you can back out of the euro-dollar future. You have a treasury yield that you've backed out of the treasury future. You've got a yield spread. And it's going to be just this. It's going to be the euro-dollar contract interest rate. That's a forward starting 3-month LIBOR minus the forward starting yield on whatever treasury note is cheapest to deliver into the futures contract. And that yield will be based on the treasury futures price. Now the beauty of this is that if you set this up as a DV01 weighted spread, you know immediately the value of a move up or down in this rate spread. I mean, here, suppose you're long this 5-year TED. You're long 500 of the set 5-year notes. You're short 979 of the first green euro-dollar. If the euro-dollar futures contract rate rises a basis point, you're going to earn $24,485. If the yield on the 5-year note future falls a basis point, you're going to earn what? $24,485. Why? Because the DV01 is the same on both legs of the trade. So, you know, you're with a little bit of effort, your position monitoring, your P&L monitoring becomes so simple. And that's important. You have a lot of things to think about during a day. You do. Well, let's make sure we understand this. This is the tedious part of the conversation. I'll make this as brief and painless as I can. The euro-dollar futures contract rate is easy. It's just 100 minus the euro-dollar futures price. Now, the treasury yield. Now, this is where your attention to detail is important. That's going to be the futures price multiplied by the delivery invoice conversion factor that applies to the cheapest to deliver note into that futures contract. And if you want to be really persnickety, you'd add an estimate of the basis. What that is going to give you will be the forward clean price of this cheapest to deliver treasury note. That'll be the forward price as of the likely delivery day for the future. I mean, lately that's the last delivery day in the delivery month. So that's not hard, but that's a detail. We'll come back to that momentarily. Once you've got that, then you can compute the forward yield. The yield for forward delivery of this thing on the last delivery day. The basis guesstimate, if you want to be bothered with it, you get from the previous night's close. I mean, unless you've got just really hellacious volatility at both the very foot of the curve and out the slope of the curve, the value of the cash to futures basis isn't going to wobble around lots and lots. I can think of and I can remember days when it did, but you know, right now, these days, that's not something you have to worry about too much. It would be a long conversation if we were to get into this. Someday, perhaps. The forward yield on the Treasury future, I'll lope through this and then you can ask questions later. I'm going to take this as quickly as I can, so this is a sprint. I'm going to take you all to be men who are schooled in the art of trading Treasury futures. So on the 22nd of August, you know that the cheap to deliver is the 5/8 of Nov 2017. It's the cheap to deliver into the set 5-year future. You also know that in the cash market, that thing was marked at around 96, 19.5, 30 seconds. You will compute carry from the 23rd of August, which is the T+1 settlement date for this Treasury note, to the last delivery day for the 5-year future. That'll be the 3rd of October. And what's carry? It's nothing but the yield interest, pardon me, the coupon interest that you accrue minus the repo financing that you'd have to pay to repo the note. This is a 1-hour conversation by itself. I'll be glad to have it with you. There'll be plenty of cards. If you trade this, this is a detail you need to know. Talking to me is wonderful. I like you guys, but better still, go out and buy Berghardt et al., the Treasury Bond Basis. It's a very easy one-evening read. First 5 chapters. And you'll see exactly why this is important. So we're going to assume that you know exactly how to do this. You come to 230 seconds. That's what your carry is worth. The forward price will be the spot price minus carry. We come to what? 96, 17 and a half, 30 seconds. Your forward yield is 1.48%, slightly more. So far, so good. You want to map this price into futures equivalent terms. To do that, you would divide that forward starting clean price by the delivery invoice conversion factor, 0.8044. That gets you to 120 3/4 of a 32nd. That's the futures equivalent price for that forward starting price for that note. Where did futures go out? 120 and a half, 120 and a plus. That means the net basis was 1/4 of a 32. You go through the same tedious exercise for the 2-year, you find that it's decimal dust. It's essentially 0. What does that mean? It means nothing except that no one disagrees that this issue will be the cheap to deliver for September delivery into the 5-year futures. Ditto for that issue. When there is disagreement over what's going to be the cheapest to deliver, this thing blows up like a balloon. That's why you need to be prepared to think about it and take it into consideration. This is a good interval to be in. I mean, if you're not familiar with doing this trade, now's a good time to do it, because there's a bunch of stuff that you don't have to worry about right now. You can cut your teeth on some of it, and then, you know, then you have experience on which you can build. So here we are. That's the trade setup. 23 of AUG. Here's how you would monitor it. You've got your euro-dollar contract rate. You've got your forward starting treasury yield. And you've got it set up in a way that you can just plug the futures price in and compute the price, or compute the yield based on that clean price throughout the day. So if you're an algo trader, you can monitor the trade in this way. If you're a point-and-click guy, you can monitor the trade in this way. If you're strategic, if you want to hold this for 2 days, a week, you would monitor it in this way. The one thing you'd want to do is to check the basis every night. Make sure that you've recalibrated this for the next day. Now, I haven't said anything about bid-offer spreads. You have to get in and get out of this stuff. And there are, I don't mean this to sound trivial, but there are 2 ways you could do this. You could post resting orders. If you want to buy the TED, what are you going to do? You'd post a bid for the Treasury leg. You would post an offer for the euro-dollar structure of your choice. You might prefer to be the aggressor, in which case, if you want to acquire this TED spread, what are you going to do? You're going to lift the offer on the Treasury side. You're going to hit a bid on the euro-dollar side. In the first case, you keep the bid-offer spread for yourself. In the other instance, you you sacrifice. It becomes part of your cost of just doing this business. So how big is the bid-offer spread? Well, for this 2.5-month interval between mid-June and end of August, you'll get, once again, 28,000 in some kind of 1-minute intervals. So what's with all the funny numbers? 0.81 basis points, 1.31 basis points. It's kind of bizarre looking, which is why I put this here. 0.5 is easy. That's the minimum price increment for the Eurodollar future. It's half a basis point. The minimum price increment for the set 5-year future on 23 of Aug was around 1/3 of a basis point, slightly less. This will vary from day to day. Okay, this is worth monitoring at least once a day because it's going to change slightly. But once you get these two numbers in mind, then you can see that these bid-offer spread levels are simply combinations of these. 0.5 is easy. 0.81. That's nothing but the minimum price increment in the Eurodollar future plus the minimum price increment in the 5-year note future. So on the way here. The good news, as an empirical matter, about half the time the bid-offer spread is 0.8 of a basis point. Only slightly less of the time, it's around 0.5 basis point. That's kind of neat. Every now and again, it blows out. Here are these values that are in the neighborhood of 1.8 basis points, 4.8 basis points. These coincide with macroeconomic events. This is 1 p.m. Chicago time on the 19th of June. The FOMC adjourned. What happened here? This is 7:29 on the 5th of July, Employment Friday, 1 minute before the headline. Ditto here. Look at that. You climb up to Mount Everest. What do you see there? 7:29 on the 2nd of August, 1 minute before payroll employment. That's an FOMC meeting adjournment. That's publication of the July FOMC minutes. It's a handful of cases. But that's what causes the bid-offer spread to blow out when it does blow out. I can go through the same exercise for the 2-year. And here again, you got kind of funky looking numbers, but they end up being interest rate equivalents of the minimum price increment in the futures contract. In this case, 1/4 of a 32nd for the 2-year note. Over this stretch of history, 97% of the time you're at 0.91 basis points. And what is that? It's just the minimum price increment in the Eurodollar plus the minimum price increment in yield terms for the 2-year note. The outliers up there, the odd lots up there, don't seem to have any macroeconomic significance at all. So I don't know what causes them. What I do know is that most of them occur between like 2 p.m. Chicago time and 4 p.m. Chicago time. Things have gotten a little bit thinner. So these might just be, I won't call it out trades. These are actionable bid-offer spreads, but there they are. I can't tell you it was an Employment Friday. There we go. So here we are on the 23rd of August. This is the offered side of the market. Okay, so if you're buying, if you're buying the TED here, let's say right at the beginning of the day, you're lifting somebody else's offer. If you exit up here right before lunchtime, and what a wise trader you would be, I commend you if you do that. You'd be exiting at your offer, okay? So you would have earned 2 basis points. Now remember, if I'm doing this, 500 times on the Treasury side. You know, what did I say that is? 28,485 or something. It's a big number. So, you know, each basis point counts for quite a bit. If you've entered and exited the trade using your resting price, if you're the price maker, then you can add the bid-offer spread. That's either an extra half a basis point or an extra 0.8 of a basis point, generally speaking. On the other hand, if you're doing this entirely aggressively, if you're hitting bids and lifting offers to exit or enter the position, then you're going to sacrifice that. You would have, if you'd entered here and exited there. Crossing the bid-offer spread would have cost you, you know, either a half a basis point or 0.8 of a basis point. That's still a good day. I mean, there's a lot that goes on there. There's a lot of activity for somebody who, you know, who's watching the market carefully. On this particular day, the 2-year TED, it's not quite as compelling. I mean, you know, you crossed maybe, what, 1.5 basis points worth of territory. And if you're giving up the bid-offer spread, then you've sacrificed 0.9 of a basis point. So, you know, that's like, seems to be a lot of work for you know, slim pickings. On the other hand, if you're algorithmically inclined, then there's plenty of shop for you to chew on. If you're not, well, then maybe this is a day you sit out. Okay, my goodness, how long? I can pause here and just start taking questions, or I can say a few things about performance bond and cross-margining. You'll have this in the presentation anyway. Let's see a show of hands. Does somebody, you know, would you like me to take questions right now? All in favor say, okay, I'll keep talking about this then. You'll want to check, you do this for any relative value trade.
He wants a spread.
You would do this for any relative value trade. Make sure you know what the cross margin benefit would be. If I do this for the 5-year trade that we've been talking about, it's 500 of the set 5-year versus what, nearly 980 of the first green euro dollar. If I don't have the benefit of margin offsets, this is just about $1.1 million. 1,082,400 to be exact. Now, the beauty of this is that for every 1-by-2 combination, for every triplet that involves 1 5-year future and 2 first greens, there's a 70% margin offset. So, such triplets, I know that I'll only have to post $657 for it. So I can find 490 of these margin offset units, and what's left over is 10 of the first green. And so what have I got? The margin that I have to post is only 1/3, not even. It's about 30% of what I would be posting without. And yeah, these are, it depends on who you are. Either these are insufferably big numbers or they're small, but this does scale. You can use the same arithmetic to get yourself to, you know, 32,000 and some dollars, or $3,280. Same drill applies here if you're trading a 2-year TED. You're going to look for these quintuple combinations. 2 of the 2-year note future versus 3 of the red Eurodollar. And the margin offsets save you, about a half of what you'd post without them. It's good to know. You want to be aware of it because that's part of your facilitation and your profit and loss is having to park cash and then get it back. Here are a few resources. And I think they're pretty self-evident. And with that, I do want to thank you guys for your patience. And
I got a question. Where do you find information on the cheapest deliver? If you're not trading cash, where would you find the data for that?
if you have access to a Bloomberg, there's a the Bloomberg DLV. In fact, it's right there up top. Cheapest to deliver function. If you're doing the 5-year TED, you look at the ZFC3 if it's today. Commodity DLV Go, and you can see in down to detail like what's cheap to deliver. There are fewer and fewer sell-side kind of dealer banks who put out really good basis analytics anymore. If you have a friend at one of those who can get you on a distribution basis report, that doesn't hurt. The more you know, the better.
Yeah.
It's really important to know like what is cheap to deliver. Equally important as volatility picks up to know if there's a question about what might turn out to be the cheap to deliver, because that affects the basis optionality, the net basis.
At that point, do you plug in both the contracts to kind of even it out, or? That's
a great question. One approach would be just to do it as I say here, just to say, okay, I'm going to take it on faith that here's a QSIP that has a 55% chance of being the cheap to deliver. Here's another that has a 40% chance. All the others have inconsiderable amounts. You could just say, okay, I'm going to bet on the 55%er. Do you want to make sure you make that basis correction to the forward starting treasury price that I described several back? The other way you could do it would be, I think, what you were hinting at, which would be to take a probability weighted average of these prices. This makes your position management and valuation analytics a little bit more problematic. I mean, you really want to do a lot of work.
If you're wrong on that, how big of what's a typical, I guess, basis point disagreement in that cheapest to deliver? Like, what's on that curve? Is it something that would be a huge?
I can say it. We don't have any experience. One of the, people have mixed feelings about this. The yield that determines the conversion factors for delivery invoicing is 6%. It's miles above market yields. So, some people hate this, but for a lot of folks, this is tremendous, because what it means is that the shortest duration member of the deliverable grade is going to be the cheap to deliver, and there really isn't a lot of disagreement about it. So this, what you're asking is going to become, it's going to become an important issue for position management of this sort. If once yields get closer to 6%,
like something that's been auctioned off, like a year ago or 6 months ago, as opposed to something that's been auctioned off this month, it's going to be, as a curve steepens, like, isn't it going to be? You're going to look at it different. It's not going to be the last oldest issuance, right? I guess I'm saying that wrong. I'm confusing myself, but it's not going to be the last contract traded, right?
You're talking, the on-the-run issue.
Yeah, the on the run.
Yeah,
It's not
you'd
really-
have to have market yields above 6%.
6%,
We'd have to be in a
that's
7% rate environment or something like that.
Okay.
In which case, the most recently issued 10-year note might emerge as the cheap to deliver. More likely would be the first old.
Mhm.
I mean, newly issued notes are always sort of at a premium.
Okay.
But yeah, you need to be keeping your eye on the other end of the deliverable basket.
Okay.
Um,
Bloomberg has that info too, if on there, or you have to.
Bloomberg does all sorts of things.
I never really used it, so.
Yeah. Now, there's an awful lot of tedious detail in this, and tedium is important because you've got to know it. The nice thing about this trade is that it allows a lot of creativity. It affords all sorts of different points of view. I mean, if you're a strategic trader, fine. You've got room to chop wood here. If you are a very high frequency trader, you've got room to chop wood. If you're a tactical person, there are things you can do here. This accommodates all sorts of different people with all sorts of different risk horizons. It rewards attention to detail, and that's especially true on the treasury leg. It also allows creativity. You have a lot of flexibility in what you might or might not do with the euro-dollar leg. So there's a lot of room for the trader's art. Your judgment on the euro-dollar side of this. There's lots of room for people with different appetites for risk. You can set up the euro-dollar side of this trade so that it's as conservative as could be. You can set it up so that it's as loosey-goosey as could be. As long as it fits your appetite for risk, this is good. That's one of the beauties of this thing. Now, for those of you who use the Trading Technologies auto spreader, or if you're a CQG integrated client user, a lot of the detail with which I was belaboring you is already available to you, and with not much work. So, if this interests you, if the position management issues look like something you'd like to tackle, if you want to get involved, one of the first things I would do would be to contact either my CQG representative or my Trading Technologies representative and say, hey, I want to talk about this. Because you've got tools at hand that will make a lot of this simple. I would encourage you to understand what's going on under the hood. That's always a good idea. But it's not like you have to sit around and do all this by hand. You have better things to do. Other questions?
How do you feel about trading them as a box spread? And
Sorry?
trading them as a box spread, like trading one curve against the other. I mean, historically, is there going to be a move? You know what I'm saying? Like,
The term structure of TED. So a
Yeah,
2-year TED versus a 5-year TED.
yeah.
For example.
Exactly. No, not necessarily. No, I'm talking opposites. So you're trading, long, short, one curve, long, short, the other curve.
Oh, when the swap spread term structure is volatile enough to make that worthwhile, that's a trade you can do all day long. And again, I mean, this is sort of interesting. For reasons that I think are pretty clear, that tends to be the province of people who have a lot of maneuvering room in the interest rate swap market, the cash treasuries market. But there's absolutely no reason that you can't do this with this listed product. You don't have to be Goliath. You can be David. As long as you take aim before you slingshot your rocks at the target, you can be David. So that's a wonderful example of something that would take some work. You have to think about this. You have to understand what your risk exposures are. But if you put the work in, That's something you can do. You can do that all day long. And as things get more volatile, as we move into a higher volatility environment, the opportunities for that kind of trade become more profuse. So this is a good time to make an investment in thought about that kind of stuff.
All right, thanks, Fred.
Thank you. Happy hunting and happy sports.